All right, guys, welcome back from closings to capital. I'm your host here, Javier Paredes, and I have a special guest, Miguel Diaz, today. And one of the reasons why I wanted to bring you guys in this today and bring him here is because one of the biggest pitfalls that people make when buying real estate is they don't buy right. I'm here with my special guest, Miguel Diaz. Tell us a little bit about yourself, brother. Thank you so much for coming.
Thank you for the invite. Amazing to be here, man.
Yeah.
Good.
Tell us a little bit about yourself.
What do you want to know?
I don't know, man.
Ask.
You surprised me.
Okay.
Tell us a little background. Give us a little couple-minute background about you. You know, where you're from, how long you've been here, and we'll get into the meat and potatoes after that.
All right.
You don't have to tell me where you get your haircut. It's okay. This is going to be a fun podcast, very relaxing.
Okay. Thank you. Don't mess up with my haircut. Okay. I'm originally from Venezuela.
Okay.
Yes.
Venezuela. Love it.
Yes, sir. So I started a business there.
Okay.
Back, I don't know, like 15 years ago, importing goods to Venezuela. And well, after that, many things happened in between.
What type of goods?
Cell phone goods.
Okay. So accessories?
Accessories.
Okay.
Yes. And I was selling parts as well.
Okay.
Yeah. I didn't, there was a point in my life that I wanted to do something different. That's where I started to do research, and I found real estate, commercial real estate. So I started, learning the ins and outs, all the terminology and all of that. And it turned out, well, I have a business administration background.
Okay.
So I'm good with the numbers.
So do you have a degree back in Venezuela?
Yes.
Okay. So you went to school.
Yes.
For how long?
Like 23 years.
You went to school for 23 years?
Well, since I was a kid.
Yeah. So, but I'm saying your degree that you have. How long did you go to school?
4 years.
Okay. You did 4 years. Okay,
Yes.
cool. All right.
4 years.
So you attended a college in Venezuela.
Correct.
Got it.
Actually, it was 2 colleges, but yes.
And were you selling cell phone accessories at the same time?
No, that was after that.
After that. Okay. So you went from getting your college degree.
I
Okay.
worked in a bank.
Worked in a bank as a bank teller, or were you the guy stealing the money?
No. No.
Oh, you weren't that either?
No.
Okay.
I was behind on the commercial side of the bank, attending businesses. Like
Okay.
if they wanted loans, credit lines, everything related to specific business. If the owner of the business wanted a credit card. So I was the one behind.
Kind of like a business development and or like, loan officer type thing. I would say business relations.
Yes.
And the reason why I say that is because when I walk into Chase, I have a business relations guy who does all that.
Correct.
Okay.
But you can call him because he's assigned it to you.
Correct.
Yes.
Okay.
That was it.
So that's what you did.
Exactly.
Okay.
Exactly. And after that, I started with the accessories, cell phone goods, and then start from the beginning, scratch, knocking on doors in
Venezuela
mall. Yes.
Wow. Like I hear that's like a country to get your hand chopped off. Like it's pretty dangerous out there, from what I hear.
It is. Well,
okay.
This was, I don't know, 17 years ago.
And that worked out there in Venezuela, door knocking?
Yeah, well, that's what I had at the moment, to begin with.
Okay.
Going into every cell phone store in the malls and, out on the street and selling and start building that.
Okay, so you're doing B2B.
Yeah.
Okay. For accessories and wholesaling them.
Correct.
Okay. Awesome.
Yes.
And you mentioned you got into real estate.
When I got here to the United States.
Yeah. Talk us through that. Like you went from college. How did you decide that you didn't want to do, working in a bank anymore and then going to cell phone parts? Like what was that first pivot for you? Because it sounds like you had your first pivot, which was from college. You got your 4-year degree. Then you went into selling cell phone accessories. That was one pivot.
I did that for a long time.
Okay.
Actually, I moved to Costa Rica from Venezuela to Costa Rica with that business.
Now we're peeling back the onion. I love it.
Yes, that's why I wanted you to ask.
Okay.
And then I hit 2 rock bottoms.
Okay.
In Costa Rica. I got divorced.
Okay.
And my mom died.
Oh, wow. Sorry to hear that, bro.
Yeah, it's okay. And actually, I never met my dad. And 1 year after my mom died, he died as well.
Oh, wow. Okay.
So that was my, rock bottom. And then I decided something had an opportunity to come here. And then I said, okay, I don't want to do this anymore. What am I going to do?
Mm-hmm.
And then I found commercial real estate.
Got it. Now, when you found commercial real estate, was it through the rock bottoms that you were going through at the time? Were you kind of like tired of the life in Costa Rica? What was the first moment that you pivoted into finding commercial and yourself into the commercial world?
I had to get out a little bit of my initial mental breakdown.
Mm-hmm.
And after that, I said, okay, I need to pivot. I need to do something different.
Mm-hmm.
And I need to do something for my kids for the future.
Okay.
That's where I found commercial real estate.
Gotcha. So your main driver at the time was, hey, I'm in a rock bottom. I want to do this for my kids. What more is there than selling cell phone accessories? Was that business that you had, was it not successful, or did you exit it and say, hey, I'm going to go on to commercial real estate?
I left it to my kids and my ex-wife.
Okay. And so they're still operating that business?
Yes.
Oh, cool. So it's a still up and running business.
Mm-hmm.
And you have no part of it. Is that right?
Correct.
So technically you've built something that you've left to your kids in the past.
Correct.
Okay. That's awesome. And most people, when they think of real estate, they think of single family homes, being a realtor. Talk to us a little bit about, what does commercial real estate mean?
That's funny because a lot of people, when I met someone new, the street, oh, what do you do? Oh, I'm in real estate. Oh, you sell houses. That's so nice.
Mm-hmm.
So
Yep.
that's the first thing.
Mm-hmm.
Yeah, commercial real estate, it's totally different.
Mm-hmm.
And it has a lot of branches. It has multifamily,
Mm-hmm.
RV parks, mobile home parks, medical buildings,
Mm-hmm.
office buildings, land,
Industrial.
right?
All
of that is commercial real estate.
Wow.
And specifically multifamily, which people live there,
Mm-hmm.
from 5 units and up in a building.
Mm-hmm.
That's commercial real estate. Up to 4 units, it's residential.
Gotcha. And so what gave you the confidence? Like, what was the first, did you read a magazine? Did you go on a YouTube video? Like, how did commercial real estate come across your desk? Because if you think about it, like you said, most people think of the real estate as being a realtor. They think like, oh, let me go sell homes. What gave you the confidence to look into the asset classes of commercial? Because I feel like that takes confidence, going in and not saying, hey, I want to get my real estate license and go the easy route and taking a license test that, takes 2 weeks to a month.
I saw a post of Grant Cardone.
Oh, there we go. Okay.
So he started like explaining that, and I said like, oh, that makes sense. I like that.
Mm-hmm.
And actually he and so many others say that they're in that space.
Mm-hmm.
Like, if I had to start it all over again, I wouldn't start with residential. I would jump into commercial.
Why? Why? For those people who are listening, tell them why they should jump into commercial. Because that's like Chinese to them.
I think, yes, probably. I think that it's where the wealth that you can create in the future is in.
Mm-hmm.
Okay? The residential is easier,
mm-hmm.
but the commercial gives you more in the long run.
Mm-hmm.
So I started to listen to Grant and a couple more. I started listening to him and learning from him.
Okay.
And I said, okay, I need to validate this.
Did you buy a course from him? Or?
Yes.
Okay. You bought a course.
I said, okay, now let me validate this information. Let me see if what he's saying is true.
Okay.
And then I started looking at some other people like Rod Cleave, Brad Sumrock, and some over there.
Started doing some research.
Correct. And the pitch was the same. And I said, oh, this is true.
Mm-hmm.
I like it. And one thing that Grant said is, if you're good with numbers, you have to start doing underwriting, because that's the way you will know if it's a good deal or not.
Mm-hmm.
There's no other way.
Right.
So that's where I started.
So one of the things I tell people is, because a lot of people ask me for real estate advice. They say, should I get into real estate or should I go into single family commercial? I say, well, single family will make you rich, but commercial will make you wealthy.
That's good.
Right. And so that's what I like to lead with when people ask that question.
That's good. Yeah.
So, all right, cool. So now your main focus is in the commercial sector of underwriting. Is that right?
Correct.
Talk to us about what does that mean? Underwriting.
Well, there's another confusion out there.
Okay.
Because banks have an underwriter.
Okay.
Insurance companies has underwriters.
Okay.
So it's the same at the end, because the lenders, the banks that have underwriters, they do exactly the same that I do.
Okay.
They run the numbers to see if it's feasible to lend that money.
Correct.
So on my end, I work with investors, running the numbers first for them, and to see if it's good investment for them. And then my work, I send it to the lenders. And I kind of initiate the process for them because they're looking already at my underwriting.
Gotcha. So you're not working for the bank.
No.
You're working for yourself?
For myself and investors.
Okay, so your main niche is what?
Investors.
And so you're acting as technically a consultant.
Correct. As a consultant.
Okay. Now, when you say you assess the property, the underwriting, what are you doing as far as what comes, like, for you to evaluate an asset? What are some of the key things, metrics that stick out to you right away to know if this is a deal or not a deal? So, as you know, people that are listening to this podcast, one of the things that they're going to be thinking is like, wow, I'm buying bigger deals. I might just be getting in underwriting. When someone's looking at a deal, what are some key fundamentals, right, that you can give them for them to understand if it's a deal, or should they just pass it and keep going?
There is back of the napkin formula, right? And that will give you a very, very rough number if it's overpriced or not.
Okay.
But you have to take it a little bit deeper than that to see, because maybe it's overpriced.
What does that napkin underwriting look like?
It is the income. You have to take the income. You have to take the expenses. You have to multiply if it's a multifamily, and the rents are $1,000 and it's 50 units, so it's $50,000. You take 50% expenses, just rough numbers,
rule of thumb,
correct?
Right.
And then take 10% vacancy out of that $50,000. You take 10% vacancy. You take 50% over that, and that gives you the NOI.
Gotcha.
Okay, so if you divide the NOI by the sales price, you get the cap rate.
Gotcha.
So once you get the cap rate, you see if you find out if it's overpriced or not.
Then one of the other metrics are you looking at? Are you looking at that cap rate that you just evaluated with the napkin underwriting? Are you seeing if it's in alignment with the market cap?
Correct.
For that market?
Correct.
Okay. And how do people find...
Either way, if it's below 5% cap,
right,
it's overpriced.
Right. And one thing I know people get confused on is with cap rates. They don't realize, like, the lower the cap rate, this is an indicator that it's more of a higher demand asset class. It could be like a class A multifamily that is close to being stabilized or that is stabilized. Talk about that a little bit. Lower cap rate, higher purchase price, higher cap rate, lower purchase price.
Correct.
Being that we're on cap rates. Talk about that for a second.
Yes, that's exactly how you said it. Lower cap rate, higher price. It doesn't have to be A class. Most of the time it is.
Right.
But if it's overpriced, it's a lower cap rate. And the higher cap rate, the lower the price. In rule of thumb, Class A properties are lower cap rates because it's higher the price.
Right.
And Class C, D properties are higher cap rates and lower prices.
Right. And I know that has a lot to do with the type of, like, for instance, like a Class A luxury multifamily 300-400 units is going to attract a very higher clientele, somebody who's got more stable income, stuff like that. So if they have the consumer who's renting that unit has stable income, and let's say their income earner of $75,000 to $100,000 or more a year in a Class A building, guess what happens? The assets, there's more stability, right?
Correct. Actually, when you have a Class A, like low cap rate entry, the Class A property has more appreciation and less cash flow because it's more stable, as you just said. When you're buying an old property, a Class C, D asset, it's less appreciation because it's an old asset, but you probably have more cash flow.
Yeah.
That's why the cap rate is higher.
Yeah.
But you have more risk.
What are some of the other metrics? Would you say cap rate? Because obviously you have other metrics that people like to mention in commercial. What are some of the other metrics that you would say are important indicators if a deal is good or not?
There are two main metrics, which is cash on cash.
Okay.
And internal rate of return.
Okay.
So cash on cash is whatever you have as a return based on your investment.
Correct.
The initial investment. And you have a yearly cash on cash, and you have, of course, an average.
Gotcha.
If I project it during, I don't know, you said you want to hold it for 5 years and you want to sell it or refi at that point. So your projections are 5 years. Then my analysis will be at 5 years, and that you have a yearly cash on cash and you have an average cash on cash, because it will project the cash that you will receive from those proceeds when you sell the property.
Gotcha.
And the other metric is internal rate of return, which is correlated as well with the cash flow in time. And that gives you, of course, a part of the return that you need. So those two metrics are important when you have investors coming into your deal, and because you will have those metrics to approach them and say, hey, this is going to be your returns based on this.
Right. The deals that you're underwriting for, let's talk about that a little bit. Are they all asset classes? Are they office space, industrial? What type of asset class are you underwriting for mostly? Or do you do them all?
I do them all.
Okay.
I started with multifamily because Grant is focused on multifamily. But then I understood everything related to the numbers. And then people started asking me, hey, do you do RV parks? Yes, of course. So I started learning all those different type of assets, and I started making them all, right? Nowadays I have industrial, like triple nets. It's easier because, triple nets, the tenant pays everything.
Right.
But either way, you have to
let's hold there for a second, right? So if somebody's listening to this podcast, you saying triple net, let's talk about that for a second. What does triple net mean?
Triple net is when you have like an industrial complex or building, you have, let's keep it simple, one simple client there. That tenant, it's your tenant. You buy the building, it's your tenant, but he pays every expenses.
Right.
Everything related to the property, like of course renovations, you don't have to do anything, and they pay taxes, insurance, they pay everything. The upside is very little. That's why it's so stable, because you can increase the rents like 3% every year, but it's stable, lower risk, lower returns.
Gotcha. And you can do that on a smaller scale, like to a salon or something like that, right? It could be done, I own a 3-unit commercial strip mall. You can do that same thing, that same strategy.
Correct. Anything.
Right.
Correct.
Yeah, and that's the way I see most leases structured in commercial are triple net leases. And for those of you guys who are listening, think of a triple net to be the opposite of regular retail real estate, residential. Residential real estate, you own a single family home, you get leaky toilet, you get the call. You get a hole, there's a hole in the roof or it's leaking, you get the call, you have to fix it. The lawn needs to be cut if that's within that lease agreement. Typically, and you've agreed to it, you have to take care of that. With triple net, you don't have to do any of that stuff.
Correct.
And same thing. One of the biggest things I always say in any type of asset that you're going to acquire is taxes. Property taxes is one of your biggest operating expenses.
And insurance.
Insurance, and obviously your debt, right? These are the biggest ticket items. And with a triple net lease, that's beautiful that you don't have to pay that.
Correct. Correct.
Awesome. So would you say that out of all the asset classes that you've underwrote, and this can be in the past or recently, it's up to you, what would you say the most desirable asset class is that you've seen?
I'm going to say something. The most common and desirable because of its fame, it's multifamily.
Gotcha. Okay.
Okay. Because it's out there the most. And there are more advertisement regarding multifamily. And when you go to institutions, like, you have those, and you see that every time in the street.
Yeah, right.
Like, you have those 300, 400 multifamily complexes and all of that. It's the most common.
And if you think about it from a perspective, most people understand it a little bit or a lot, whatever, is because they probably have lived in one of these buildings in some point in their life, right?
Correct. Or someone that has.
So, okay, you would say that's like the Hall of Fame of real estate, right? But do you feel that underwrite's the best? Now, when you say Hall of Fame, you're talking from a popularity standpoint.
Correct.
Let's talk about numbers, because underwriting's about numbers. What do you see pencil out the best?
Nowadays?
Yeah.
I would go to RV parks.
Okay.
Creative deals in general.
You talking about like the ones I like to lock up?
Exactly.
Okay.
Because you have the power to negotiate terms.
Gotcha.
Nowadays, the interest rates
are just killing. Yeah. And not only that, for people who are listening, the debt structure on multifamily, it's not 30-year fixed debt like residential. You have 5, 7, and 10, right?
You can have a little bit more, maybe 15.
But most commonly is what, 5 to 7, I would say.
Yeah, could be.
And what's happening right now is what? With the multifamily game. Like you guys are probably hearing on the news right now that a lot of these loans that are at 5 and 7 years are due. What do you think is going to happen there? Do you think that there's going to be this huge multifamily crisis?
It's been happening in the past year and a half. But there's a lot of people advertising that or saying that, but it happens like behind the scene. So there is that, and the problem with that is that most of them, they bought it with 2-3% interest rate. So they projected to refi or sale at some point around this time.
Exactly.
And when you have to refi, of course, it cash flowed at the time you bought it. And at the time they bought it overpriced because the cap rate, the interest rate were very low and it cash flowed, of course. And so at this point, it won't, because you can cash flow the same thing at 6.5, 7% interest rate. So they're trying to do whatever it takes. Sometimes they have to cut those losses.
Do you think the bank is just going to say, hey, call it quits and just add it to their balance sheet and call it the day? Or do you think that they're going to try to work with these investors and extend the loan, maybe give them another year or two to kind of let the market recoup?
They're trying to do something. Actually, I have met lenders, big lenders, that are coming in to those deals to negotiate, and they get that. So those lenders, like outside lenders, not financial institution, like they come into the deal. They say, okay, I'm going to save you, but I need equity.
Yeah.
So they pay that.
Gotcha.
They control the debt and they control the asset.
Got it. So those people who are sitting maybe on the general partner side, they're no longer a general partner, or
Maybe they still are,
gotcha.
but there's some external people, coming
Yeah.
in to help.
Let me ask you, and I can't recall names, but I've been seeing like a lot of really big financial institutions, very savvy investors that own, 10, 15,000, units that are, defaulting because of the new debt structure their loans are coming due. Why do you think, I just feel like if you're that big, you have this big of an organization, in my mind, I mean, maybe their organization is not that big, but why don't you think that somebody within their team would have been able to pivot or do something more creative to mitigate them defaulting on 1,000, 2,000 units? Have you seen any of those stories recently where these big firms are like defaulting on like 1,000, 2,000 multifamily units?
The thing is that remember that each deal is different for them.
Mm-hmm.
So whether it's a syndication or a fund,
Mm-hmm.
they need to complete a cycle.
Right.
So if it's just you as an investor, it's different. Then you get creative and then you see what you can do.
Mm-hmm.
But when you have a pool of investors backing that property, then you need to complete the cycle. You have to refi or sell. And that is the critical thing here.
But they're literally letting these things go. And that's tarnishing their brand.
Mm-hmm.
What do you think about that? Do you think these guys are going to continue to be able to do business, or?
Probably. Maybe they have a lot of things on the back. And I assume big firms, as you say, they had to run through every scenario possible. And they came with that conclusion. Why? I don't know.
Yeah.
Those are those things that you don't know. That you don't know that behind the scene.
Right. Mm-hmm. You don't know the whole story.
Correct.
Yeah.
How they come up with that conclusion to do that.
Yeah. Okay, so we talked about multifamily being one of the most popular asset classes. Could be a potential one of the safest investments, you would say, maybe. I mean, if it's underwritten correctly, right? Right now, where you're at in your consulting business, where do you plan to take your consulting business? Are you just consulting for equity? Are you consulting for a fee? Talk about that for a second, because I think a lot of people get confused. And one of the things, I want these listeners to take away from this is you don't need a bunch of money to insert yourself into a deal.
Correct.
And a lot of people think that they need a bunch of money, but you have something that's special. Talk about that for a second.
I developed a skill, and that's something that helps to get into the game without a lot of money. So if you develop a skill in time, then you will find it, and you have to be consistent, of course.
Mm-hmm.
I do it as a consultant for a lot of investors that are sold investors. So they don't want partners.
Mm-hmm.
So I just act as a consultant. But when the time comes, if it's a good partnership, if it's a good operator, I can be part of those deals.
Gotcha. And so you're exchanging your skill set for an equity position in the deal.
Not right now.
But this is what you plan to do.
Yes.
But there are other underwriters such as yourself that have exchanged equity or their skill set for equity in a deal. Is that right?
Correct.
Okay. What does that typically look like? What's like a good rule of thumb? Like, let's say somebody's listening to this and they're like, man, you know what? I've been underwriting, commercial, and I didn't realize that I can insert myself into a 200, 300, 400 unit deal, or maybe a 50 unit deal. It doesn't matter. They didn't have to find the deal. They didn't have to negotiate the deal. They didn't have to raise the capital. But they're bringing their skill set of underwriting to the table, evaluating the asset, making sure it's a good deal. What is a typical equity split for someone who has that skill set and that's listening to this, and maybe they're like, wow, I didn't know I can insert myself into the deal?
There's no rule of thumb. I think You can negotiate that at some point. There are a lot of people that has that underwriter be on the team, and if it's 2-3 people, in the team, that's part of your negotiation. But if, let's say, a bigger firm asks me to do that, they don't have an underwriter in house, and ask me to do that, I can negotiate that 1%, 2%, whatever. Because if it's a big deal when you have investors, and if it's a syndication or a fund, you have the GP side. So you ask for, okay, I do the numbers instead of getting a fee for this, like just for
Consulting fee, right?
Correct. I want to be part of the deal.
But you need to know that thing is going to get to the finish line.
100%.
Right. So
that's something that happened to me a lot. I started doing that.
Right.
People were asking me like, hey, just do the underwriting. Once we close, once you get a deal, then you be part of the deal. And but it never happened.
Okay, but here's what I can see people thinking. Like, okay, I get 1 to 2% of a 200-300 multifamily deal. How do you protect yourself? Right. It gets across the finish line. How do you know for sure that you're in this deal? How are you being protected? How are you protecting your time?
Because you're part of the GP side.
Okay.
It has to be in the documents.
Okay. So you're signing the PPM, right? And that's what's keeping you.
You should be part of the LLC on the GP side.
Gotcha.
With that small percentage.
Gotcha. Okay. So then that's what's keeping you in the deal, knowing that your time and skill set is in exchange for an equity position.
But you have to know that operator is a good operator.
Yeah.
It's not just crossing the finish line.
Right.
It's the operation of the
So
property.
what would prevent you from, your business model is more consulting for a fee, or is your business model more consulting for equity? Or is it a little bit of both?
Now it's just consulting for a fee mostly.
Okay. But why wouldn't you want to consult for equity? Or like, why wouldn't your sole focus to be consulting for equity?
The consulting for equity will give me the long-term game.
Tomorrow money.
Correct. The not tomorrow money.
Yeah.
Wealth money.
Right.
Legacy money.
Right.
Right. Correct. So now I'm building that initial phase on the cash flow for the business, and then I'll start doing for the equity.
Gotcha. Okay, so you're kind of structuring it to where, like, hey, look, I need this amount of today money, and then eventually I'm willing to insert myself into deals for equity.
Correct.
Deals that I know are going to get across the finish line because I know that it underwrites well. There's a good operator in line, right? And this is something that can be a long-term, play for you and your wealth.
Exactly.
Right. What is an operator to someone who's listening to this? What?
The operator is the one who manages the deal, who makes the calls.
But how do you know if they're a good operator?
Track record.
By track record?
Correct.
Okay. And then I mentioned earlier, like there are some operators that are either doing cash calls or they're defaulting on their stuff. Obviously, there's still some risk associated with you getting in this deal and it not working out, right?
Yes.
So you have to think about the worst.
Yes.
Right.
Let's
say, hey,
well, that's part of the numbers, right?
Yeah.
Part of the analysis. If you're good with the worst case scenario, then it's a good deal for you.
Yeah.
Right. Of course, we don't have a crystal ball.
Correct.
And we don't know what's going to happen in 3 years.
Correct.
It's part of it.
So let's say you did have a crystal ball right now. We're in a very volatile time, right? There's a lot of stuff going on. We just got a new president. There's tariffs going on. You got a lot of volatility, like the stock market's like not doing good. Cryptocurrency's going down. You got a lot of funny stuff going on right now. Today, in 2025, how do you take those things that are going on in the economic system and implement it into your underwriting to have the most secure underwriting possible for that investor?
The upside, we have to be very conservative.
Yeah.
So,
but what does very conservative mean?
Okay. You have to do a market analysis to see specific, because it depends on location and type of asset. Okay. So what's your type of tenant? What is your location? Population growth, employment. You have to take that in consideration. There are many states or cities that the rents are going down.
Gotcha.
They're not going up.
No.
Or they're flat.
Uh-huh.
So once you do the numbers, that's what you have to take consideration.
Yep.
And there's something that it's called, you can distress the property, the sensitivity,
Mm-hmm.
and then you run that. If it's kind of good, then you know it's good.
Yeah.
So you have to be very conservative when you run those numbers.
Yeah. That actually brings me to my next point. Like you said, the rents are going down, right? And the reason why is a lot of these multifamily developers overbuilt. Some areas are overbuilt with multifamily. It got bananas. And from what I've heard is, I don't know how true it is, but like Orange County, the county that we're in, I heard they're like being very strict on giving out multifamily permits because it's just so overbuilt. It's oversaturated, you know? And I always tell people that, like, I love multifamily. I love it from a scalability standpoint. It's easy to understand. I lived in a multifamily property before, but I feel like there's just not as much opportunity in that space, right? For the creative stuff. And I feel like a lot of markets are oversaturated. What do you think about the supply base versus demand right now in certain markets? Like I think it was Austin or Dallas that I heard recently, and just rents are climbing down just because it's oversupplied market.
Correct.
And I don't, I'm not going to reference what exact market it was. It could be one or the other, neither one. But I think it was a market in Texas that there's overbuilt. What do you see happening? Do you see a decrease in 10% in rents? How do you feel like these developers are going to be now are going to now be able to pivot? Because think about this. Not only are rents going down, the tariffs are happening, supplies are getting more expensive. So think about the people who underwrite from ground up developments. If they wrote 5-6 months ago, they weren't thinking about tariffs.
Correct.
I guarantee it.
100%.
So,
same as the interest rates. In 1 year, they went from 3% to 7%.
Yeah.
Nobody expected that at
Yeah.
any point.
Yeah. But in your mind as an underwriter, how do you view that? How do you view like, okay, oversupply, we have tariffs going on right now. What do you think how do you view that? And what also do you think, how do you think these developers will pivot?
I think they won't. It's just a little bit less cash flow now. And I think for developers or any real estate asset in general terms, residential, commercial, you have the ups and downs of the market. That's a down for them. Same thing as 1-2 years ago with the interest rate that high. The residential developers, they were kind of low because they weren't able to sell. Now they're going back up. So it's the same up and down of the market. I know they're oversupplying themselves. I know there are a lot of ships out there with materials because they don't know, I'm going to charge you this, no that. So
hey, let's turn the ship around.
yeah, basically. And it's part of the, let's say, market correction could be.
Correct.
So yes, it's complicated numbers wise, but they don't lose money. They earn a little bit less. So it's kind of that in terms of the supply that you told. And on the side of the rent, there are a lot of new developers that are already built and they need to fill it out. So that's when the concessions coming in.
Right.
Give you 1 month for free. I give you 2 months for free. It's a high rent, but you're getting 1-2 months for free.
Right.
So those concessions starting to get into that. But it depends because there's a lot of new builds that are premium, luxury, with those amenities.
Correct.
Bowling.
Beautiful.
Yes.
Beautiful buildings. Pickleball courts.
But not all the, it's that's a niche. That's a type of tenant.
Right.
That's not for everybody.
Right.
$1,800 for a studio apartment, you know?
Right.
So you have the other niche. And when you buy a class B, C asset, you have your type of tenant, which they cannot pay. They would love to play peekaboo
Yeah.
there, but they can't because of the income.
Right.
So that's when there's a piece of the pie for everyone.
Yeah. So if somebody was listening to this, right, and they say, hey, I want to get going in multifamily investing, commercial, 4 units or more, what do you think in today's climate would pencil out the best? Unit count and asset class?
There's this theory. The bigger the asset, the bigger the property, the less the risk,
Mm-hmm.
because you have more units.
Mm-hmm.
If you have,
you're spreading out your risk.
Correct.
You have
10 units, you have 2 units empty,
Right.
which is nothing.
Right.
That's 20% vacancy.
Correct.
If you have 100 units and you have 2 units, that's 2% vacancy.
Yep.
So you spread that risk, and of course, the bigger the better.
Right.
However, and that's something that Grant says, and a lot of them says,
Mm-hmm.
there's like a minimum between 16 and 32 units.
Right.
Like no less than that.
Right.
It's intimidating because there's bigger numbers. That's why it's important to be educated.
Right. And to get someone like you involved.
And yes.
To help underwrite.
Someone with experience, correct.
To help underwrite the deal, because
and not just underwrite the deal, because of course the numbers are important, but from there, the underwriting, that initial analysis,
mm-hmm.
once you have like all done, once you close and you have everything number wise set,
right,
that underwriting is your business plan,
mm-hmm.
because you're buying a business.
Right.
So that's your business plan. You have to stick to that and try to over deliver to make it better.
Right.
So that's important.
Which entails another thing, right? Like multifamily is a team sport, especially when you're doing these big asset classes. Because if you underwrite and that looks beautiful and the business plan doesn't go to according because maybe there's a shitty ass, operator that is destroying the whole entire asset, then you got problems.
Correct.
And then that underwriting model that you did is not going to perform to expectations. So it's a team sport in order for this really to work.
That's where we're talking about skills.
Right.
So I have this skill, but I can't do everything.
Right, of course.
So then you are a big operator. You know how to operate properties based on your experience.
Right.
Then we work as a team.
Mm-hmm.
I do my numbers. You understand the numbers, but you're not doing them.
Mm-hmm.
I do the numbers, and then you take, your operation going, because that's your expertise.
Correct.
Like there's one of those mentorships. It's called the hats.
Mm-hmm.
Each one it's a strength, and everyone, it's a different hat.
Mm-hmm. Right. So let's talk about really quick. So we're talking about multifamily right now. One of the things that you mentioned a little bit ago, that one of the most favorable asset classes that you're seeing pencil out is RV parks. Why are RV parks penciling out better than multifamily? Or is this right now, or has this always been that way, or is this based on any RV park that you've seen in the past?
I think it's always have been, like that.
Okay.
Yes, but it's a different niche. There's a lot of people that they don't know about it, so it's based more on I don't know what that is.
Mm-hmm.
But in RV parks, there's things that if you have it, it's an amazing asset, which is uniqueness,
right?
Because it's a outdoor hospitality, right?
Yep.
So you have uniqueness, and you have multiple sources of income within that unique park.
Yep.
So that helps you to do that. In a multifamily, you have a limit.
Yep.
To source another income.
Correct.
But in RV parks, you can get creative. You have space. You have
Right.
land. You have, let's do a trail here.
Correct.
Let's do, I don't know, ATVs.
Right.
Whatever.
Right.
Have a lake. Let's bring some, I don't know, whatever, kayaks.
Yeah. So
boats.
your point is, so the listeners understand, your point really is you can have a lot of sub businesses within this asset classes that give more money to the bottom line.
Correct.
And so if there's more money going to the bottom line because you have all these sub businesses that you can't do in multifamily, that means that the NOI is going to be sexier. And if the NOI is sexier, that means that property valuation is going to be even sexier.
Correct. And actually, you have two types of tenants as well.
Yeah.
You have the guests,
Correct.
the RVs, the short-term RVers, and you have potentially, most of the time, you have long-term tenants there.
Mm-hmm.
They park there. It's affordable housing.
Right. Right. Because there's some long-term parks that are only long-term. I had a friend of mine that just picked up a long-term park where it was only long-term tenants. They don't do any transient.
Mm-hmm.
So, okay, so that's why you see specifically RV parks pencil out a little bit more than multifamily.
Correct.
So with multifamily, you have your rent. You have typically you can charge if you have overhead parking.
Mm-hmm.
If you have a laundry facility.
Correct.
If you have storage.
Mm-hmm.
And what are some other common ones that you might see?
Well, some fees here and there that helps, but
little stuff.
That's the thing.
Right.
That's
little things.
No more than that. But if you have the washer and dryer into the units, then you can have a laundry facility. So
right. And typically, those ones that do have a laundry facility are going to be more like C, D classes. B and A are going to typically have them inside the unit.
Correct.
You're talking about a higher clientele, and you're talking about a more sophisticated individual who's going to rent that property out. And then that individual paying that higher dollar amount needs to correlate to that unit being in a certain status, right?
Correct.
So with RV parks, so you guys understand, you have a lot of sub-businesses. And these sub-businesses are the firewood sales, the ice sales, the pad sales. If you have a water park, are you charging entry to the water park? Are you having special events at your park? Do you have a pavilion that you rent out? Do you have a wedding venue there? Do you have Airbnbs there? Do you have glamping there? Kayak rentals, golf cart rentals? I mean, man, I can keep going on and on and on.
Mm-hmm. Mm-hmm. That's why it's so important. If it's very unique and you find that one,
right,
you can develop that,
right,
like, really nice.
Yeah, no, and absolutely, and that's why one of the things I love about this asset class, RV parks, is there's way more creative deals in this space, and the reason why is because they can't get financials. They don't have the financials the 2 years that the banks want, and so it forces these sellers to have a natural conversation into creative. So
because they don't have any option.
Correct. They don't have any option if they really want to exit that property.
Correct.
And most of these sellers are in a position and that's the good thing. I always tell people a good telltale sign if a RV park operator doesn't have organized financials, that means that they're not organized in other areas in the park. And to us, that's a value add.
Correct.
Talk about that. How does a value add impact the park and the bottom line? What does a value add mean in real estate?
The value add, yes. In general, real estate is that you buy an asset, buy a property that it's mismanaged or doesn't have any more things that you can do about it. Then you invest money. That's called CapEx, capital expenditures. Mm-hmm. And with that money, you build cabins, glamping. You create a store, add kayaks, for talking about real estate, right? Mm-hmm. And that investment will give you more income. So once you purchase any property and you add income, that's forced appreciation. Mm-hmm. You are forcing the appreciation because you're buying a business and it's valued based on the income. It's an income producing property. Mm-hmm. If the income is increasing, then the value of the property increase.
Gotcha.
So that value add is because you have room to increase the NOI or the income.
Yeah. And that's what I love about commercial real estate. I feel like you put all this work in, right? You do all these improvements. You create all these little micro businesses or sub businesses, whatever you want to call them. The more you get to that bottom line, the more efficient that investment is running and gets more money to that bottom line, the more the evaluation of that property.
Correct.
And one thing that I come across, being that I deal with a lot of direct to seller, is a lot of these sellers don't know how to price their properties. they're not in the business to understand on how is my property evaluated. And when we get their financials, a lot of times they're messy. They're not put together, which again is a good sign for us. It's more work for us, but it's a good sign for us because how you do anything is how you do everything.
Correct.
So we know if they're unorganized in that area of their life, they're probably not running their business to the most efficient way possible that it can be.
Exactly.
And so then we look at it and say, hey, you know what? Can we add the golf carts? Can we add the ice machines? Can we add an arcade? Can we add kayak rentals? What other things can we do to this park to make it unique and to make it unique and make more money to the bottom line?
Correct.
And I know me and you had this debate recently. And one thing I always tell people I don't like about residential real estate is I have an Airbnb portfolio. I got a co-living portfolio, and I have all these little micro businesses within residential real estate. And don't get me wrong, I have very organized books. I have a professional bookkeeper and everything. So could I exit this portfolio and sell it as a portfolio with a cap rate to an investor? Absolutely. But if you have one residential piece of real estate, could it happen? Yes. But it's just not, to me, it's not as appealing of an investment from a scalability standpoint and efficiency standpoint. If you look at a piece of residential real estate being a business and you trying to sell it based on NOI.
Correct. Yeah, you can't.
Yeah. You can do it, but it's a very savvy investors kind of laugh. They're going to say, oh, well, I'm not going to buy your property based on NOI, you know. No, that comp up the road at 123 Main Street, by the way, it sold for $300K. I don't care that your property's making $150K a year. I've actually sold a property at NOI in residential real estate before, but it's rare and it's hard.
Yeah,
and it's a lot of it's a lot of pulling teeth, you know. And you're probably not going to deal with the most sophisticated investor.
Correct.
Right?
Yeah, but it's possible.
Yeah.
Right?
Yeah.
It's like creating a business.
Correct. It is a business. It is a business.
And you created it.
Correct. It is a business.
And I'm buying the business already created.
Yeah.
You know, I don't need to deal with contractors and this and that. How much is it?
Right.
Boom, that's it.
Right. It's an existing business that's already running and producing cash flow.
Exactly.
You know.
There's a lot of people looking for that. We were talking
Of course. And that's what I like about, you know, guys, that's what I like about bigger deals, commercial deals, is because not only are you buying real estate, you're buying business as well. You know? And, you know, when I used the analogy earlier, I said, you know, residential real estate will get you rich, but commercial real estate will get you wealthy.
Correct.
And that's a true saying.
It's a long-term game.
Yeah, that's a true saying in the business world too. Like, you want to make a lot of money, long money, and a lot of wealth. Business buying is great. Let's talk about for a second how me and you work together, because I want you guys to know the reason why I brought Miguel on today was because I've been in the game for 10 years. I have developed a portfolio of real estate, and me and Miguel are in a mastermind together. He's actually the underwriter there. I'm in the mastermind as a student. He's in the mastermind as a underwriter, and he's the underwriter in that community. And we actually have partnered together on getting deals together. Let's talk about how that partnership looks like. And the reason why I brought him on here today, guys, is so you guys get value out of Miguel and his underwriting tactics, and see how he has a skill set and I have a skill set, and how we have combined our superpowers. Talk about how me and you have partnered on some of the deals we've done in the past and how we're working together so people understand how they can take some of their superpower and combine it with someone else's superpower.
I think when you build a team, you need to have different superpowers, different skills, because that's how you complement to each other. So I run the numbers. We debate a lot about the numbers.
Why are you always arguing with me, man?
Because you understand them, and it's important. So you have to understand.
Do you like dealing with me, man?
Yes.
You do?
Yeah.
Okay.
Yeah.
Be honest with me, man.
100%.
All right. Cool. All right.
So that's part of it. And you have your expertise and experience. What's your strength? Talking to sellers, negotiation, operations, SOPs, that is your superpower. You have developed that
Mm-hmm.
in the time and have developed mine. So once you combine that, then you create a good business.
Right.
If we were both underwriters, okay, now what we do,
Mm-hmm.
right?
Correct.
And if we do both our expertise in talking to people, then okay, and who runs the numbers?
Right.
What do we do?
Yeah.
So that's why it's important.
Yeah. And we're able to create like one big fire, right? Because you have your strengths, I have my strengths. So the strengths that me and you have, how has it complemented each other with us doing real life deals? So people understand.
We have some stories.
Yeah.
It's good because you talk to people, you talk to sellers, direct to sellers.
I don't like talking to people, man. Come on.
So you talk direct to seller, try to get that engagement with them, build that relationship, find the information for me to run the numbers.
Mm-hmm.
And then once I run the numbers, we debate on that
Mm-hmm.
to understand what would be the best structure to talk to the seller again.
Mm-hmm.
So I create some scenarios for you to give you information and material to talk to the seller again.
Mm-hmm.
And no more than, I don't know, 4%. You know that.
Mm-hmm.
You're going to try to negotiate 2.5.
Mm-hmm.
I know. But you have that cap.
Mm-hmm.
And that's based on that. And one of the things that you and I are good is speed.
Mm-hmm.
So if we have one deal, okay, move it. Boom, 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 boom.
Yep.
Then because that's the name of the game as well.
Money loves speed.
You have to.
And even like the recent deal, like me and Miguel, we submitted 2 LOIs about 2 weeks ago. One was for 1.7 million or
Mhm.
1.75
Mhm.
was it? I think it was something like that. That was for a mobile home park. And then we submitted another LOI for 1.5 million.
Mhm.
That was for an RV park. And so the way me and Miguel are working and the capacity that we're working in is he's the underwriter, right? He's behind the scenes. Think of him like he has like a command center. Like he sits behind like 15 computer screens. He's got like the high executive chair that he sits on, and he's just running and crunching numbers. That's just what I view at his home office. I had to ask Betty what his home office looks like, but this is what I don't know. I just come up with this assumption in my head of your command center.
Your vision.
But anyway, so he's able to take his skill set. And even though that I understand underwriting, I can underwrite, but not to the level he can. So why not pass that baton to Miguel to where he can do all the underwriting? And I'm the visionary in the project. I'm negotiating. I'm writing the contracts. I'm the one saying, hey, look, this looks good on this park. And even though that I do say those things, what I like about you is you have experience not only as an underwriter, you also have experience used to asset management, if I'm not mistaken, right?
Have some. Yes.
So yeah, you have access. You have had access to larger assets to where you understand some of the ins and outs and stuff like that,
Correct.
right? And so I'm able to bounce these ideas off you and kind of get your point of view along with my point of view and see, what works together. But we're out here submitting LOIs on properties, tying them up, raising capital, and then, closing on them, right?
Correct.
So we're able to complement each other in that capacity.
And remember that underwriting is assumptions.
Mm-hmm.
It's based on your experience, what you have seen and what you have done. And that's a good thing because that's when I do my part as a conservative
Mm-hmm.
underwriter. And then we debate that. Just do you think based on your experience, if this is possible?
Gotcha.
Or not? Because that's part of the projections and more, even more in RV parks that you can get creative.
Mm-hmm.
And then we can build a event venue. We can
Correct.
build this and that. And, that part is important for you to understand that. So if that conservative side between you and me, it's fine. We know that we can over deliver, which is important.
So what's like some for the people who are listening to this, right? What is some documentation that they can obtain from the seller or broker, which, let's talk about seller, but let's say they're working directly with a seller who wants to sell a piece of a property, whether it's multifamily, RV parks, it doesn't matter what asset class it is. It could be even a business. What are some documentation? What are first steps that I can take and get the proper documentation out of the individual that I'm trying to buy their business or their piece of real estate from, commercial real estate, that will help me evaluate this deal?
Income.
If
it's a multifamily, it's a rent roll.
Okay.
Or if it's a business, what's the income?
Correct.
Right. And expenses.
Right.
Preferable. There's something that it's called the T12, which is the P&L for the past 12 months, month by month, because you have a balance sheet for the whole year. That helps, but we need the month by month. It's important to understand the ins and outs of the business. Even more with RV parks, because you have seasonality. Okay, with multifamily, it's more stable during the year. But even though you need to understand if there's 2-3 months that were not stable, why?
Right.
What happened there, right?
Right.
But in RV parks, in hospitality, you have seasonalities, which is important to understand that once you move forward with the deal. And you can, income, expenses, that T12 rent roll, if it's the case, we can start with that.
Gotcha. And then once you have that, you do your initial underwriting.
And I need the terms. It's important.
You need the terms.
Very important.
If it's a creative deal.
If it's a creative deal, correct.
And
I
if
need to understand that. I need to know that.
And if it's not, you need to know what the terms for the new financing is going to be.
Correct.
So whether it's a creative deal, guys, or if you're going to obtain new financing with a financial institution, you need to know what their terms are going to be.
Correct.
Right. Because that is going to be.
It's easier if it's a conventional.
Right.
If it's a DSCR loan, what are the interest rates.
Approximately.
Correct. So you can start doing that.
Right.
But if it's a creative deal, then you need more information.
Right. Okay. So step one is you get all their expenses that you can possibly get from these people. Because I've noticed, as you know, I talk to these people, they give you thing in pieces. It's not really.
Napkin.
You're right. Exactly. They say, "Oh, what's your expense ratio? Well, can you give me your expenses? For the last 12 months or 24 months?" And they give you a napkin. Right? It's crazy, right? But again, to me, that's a good sign. I know from an underwriting perspective that's not a good sign. But I'm going to tell you on my side, I think that's a great sign, because if they're unorganized there, just imagine how much more things they're unorganized within that asset. And to me, that's a value add, because you're not running the asset the right way.
Correct.
And, sometimes, guys, when you do a value add, it can be simply as you coming in and just bumping up rents. That could be a value add, guys, just bumping up rents. And if the market predicts you bumping up rents, it dictates that and you can bump it up without doing any renovation. Well, there you go. And this is what Miguel was talking about earlier. And I'm just going to use multifamily as an example. This is why people like big multifamily deals that are, 70, 80, 100 unit plus. When you bump up the rents 100 per door, that's a pretty significant number to the bottom line, right?
If it's a big asset, yes.
Correct. If it's a big asset. So if you have 100 units, you have 200 units, 300 units, 400 units, and you're doing your evaluation, you're like, you know what, this is a value add, but it's only a value add from the perspective of us bumping the rents. Everything else is maximized, but the rents are a little bit low, right? And you can come in and bump the rents up slowly by slowly once the lease agreements are up for renewal. That's powerful.
100%.
That is super powerful. People don't realize, $100 doesn't sound like much, but if you do it across 200, 300, 400 units, that's pretty significant.
Yep.
To the bottom line.
It's a lot of value add.
Yeah, that's a lot of value add. So with RV parks, me and Miguel have been collaborating lately and working with RV parks, just acquiring properties, in the East Coast, because, we have that vision of, one, it's a great asset class. It's, me coming from the hospitality background of the years and years and years of experience that I have in the hospitality, Airbnb, and running the Airbnb portfolio that I have. I just saw so many parallels, I always tell people, if you run an Airbnb portfolio or even an Airbnb at that, you can run an RV park. It is not rocket science, guys. It is not rocket science at all. But the main thing where I see people making mistakes is they don't buy right. Let's talk about for a second, what are the biggest pitfalls you see people making when they're underwriting deals?
Trying to make it work.
What does that mean?
You can push, numbers are inputs, right? You just populate a spreadsheet.
Hey, you can always change a number.
Correct. And I think could be the mistake, because if you try to force it, then you say, oh yeah, we can get it to 1,500, but you can't. But if you input 1,500, it looks good.
Mm-hmm.
But when you start performing, when you start operating, then you don't. That's why it's good to be very conservative with the numbers.
Gotcha. So people forcing the numbers.
Mm-hmm. Or don't understanding the numbers or the business.
Yeah.
Because this happens not just with multifamily. This happens with any asset or any business.
Yeah.
Laundromats or hair salon, whatever. It's exactly the same.
Would you say it's more important? Okay, let's say you're somebody who knows the numbers really well but doesn't understand the business model. Would you say that's a pitfall for that deal? Would you tell them to back out or not move forward with it? How would they mitigate risk if they knew the numbers, they understood the numbers, the property penciled out, right? But they don't understand the business model.
They have to understand the business.
So
and if I tell you something in numbers wise about an RV park that I'm doing the business.
Mm-hmm.
If I'm telling you something that it's not, you're going to say, no, we cannot do that.
Mm-hmm.
So if you are going to operate the business, you have to understand the business.
Mm-hmm.
And that's why, of course, not in the creative side, because maybe it's a seller financing, but in general terms, when you ask for a loan,
right,
they need to know that you have experience.
Right. They're going to want to know, like, what's your experience in this vertical,
right?
This asset
because
class.
It's a business,
right? And that's what the underwriter's job is to do. That's working with the bank, is how do they mitigate? So an underwriter for a bank, their job, one of their sole jobs is to do exactly what you hear: underwrite, mitigate risk for that bank. And they don't like to go outside the box. They want to stay right within that box. Whatever their guidelines are, it's their guidelines.
Correct.
And they don't like to bend the rules. They like to stay very strict on what their guidelines are. And that's one thing with banks, just like you said, you're going to have experience in that vertical. And if you don't have experience in that vertical, the only option that you have is to partner with somebody who does.
Correct.
And so then you might be giving a portion of that deal away.
Correct.
But
you're getting into the game.
You're getting into the game.
So next time, now you have the experience.
Yeah. Yeah. And that's the thing, one of the things I want you guys to pay attention to is, we're going to recap here a little bit. A lot of people think that to get in these large asset classes, you need millions of dollars, right? That's false. We already unfolded that. A lot of people that want to get in these asset class thinks that you need to know everything. That's false.
Mm-hmm.
We uncovered that as well. The most important thing that I want you listeners to focus on is, when you're getting in the game, the way you can wedge yourself into a deal. Think about what type of skill set you have in a deal that you could bring to the table. Is it marketing? Is it asset management? Is it property management? Is it underwriting? Is it capital raising? Is it acquisitions? Right? I just named 6 different verticals there. Yep. And out of those 6, if you have a strong, that's just 6. There's more than that. I can keep going on.
Mm-hmm.
But if you're good at one of those things, you can insert yourself in a big deal.
Yeah, I think the key word here is value.
Right.
You have to add value to someone to be there.
Correct. And so that's what Miguel has built. He's built a consulting firm for commercial properties, all asset classes. He's built something that is now evolving not only into consulting, because he saw that, hey, I got a skill set that I have cultivated that has now correlated into deals. So where not only is he consulting for a fee, he is consulting for equity positions.
Correct.
Going back to what I said, guys, earlier, he didn't have to fund the deal. He didn't have to find the deal. He didn't have to negotiate the deal. He doesn't have to manage the deal. You are literally solely just running numbers for an equity position or a consulting fee.
Correct.
Now, are you working with any big firms for consulting? Are you working typically, like, what does your ideal client look like? Is it just big firms, or is it, the small mom and pops? Is it guys like me?
I've been working with a lot of people.
Yeah.
Yeah, actually, realtors, brokers, they need something, whether it's an investment or they need to present something because they're selling a property. So it's easier to sell the property if the investor or the buyer see the numbers.
Mhm.
They don't understand
Gotcha.
how to do that. So
Got it.
I do that as well.
Got it. Okay. So, big commercial broker or a commercial broker comes to you with a deal. You underwrite it. They put that in their OM,
Correct.
their offer memorandum.
Correct. They have the commercial brokers, they have like a template. So what they do is that they just input the numbers from the T12 from their client and the seller.
Right.
And that's it. That template does everything, but they don't analyze it properly to project it. Not all of them, but most of them.
Yeah.
So that's something there. So I can help, do that. And then they kind of easier for them to sell it.
Right.
Hey, this is how it's going to be. This is the potentiality of this. So it's easier to sell.
Right.
And big firms, of course, as well.
They want to package it together the right way. That way, when they go to dispo it looks presentable. It looks, attractive number wise.
Correct.
And it's been looked at from a professional consultant.
Correct.
This leads me to one thing, I've noticed in this industry, what I've noticed is, dude, there's a lot of knuckleheads that don't know what they're doing, and they're handling big assets. Like, I've seen people take down 10, 15, $20 million assets that don't know what they're doing. They just have been able to take it down because of the money.
And that's something about
that's
banks.
Scary.
About banks, you can have the money, but they don't gonna lend you because
Correct.
you don't have the experience.
Right.
Whether you have the money or not, if you don't have the experience, it's a no for them.
Yeah. Yeah.
They need to see the experienced guy in the company, in that LLC that's purchasing the property.
Yeah.
If not, and you have to give them your portfolio, your schedule of real estate.
Yeah. Correct. And if you don't, then they're not going to approve it. That's one of the conditions.
Correct.
On the loan.
Yeah.
If you don't give them your portfolio, then they're going to look at it as like, oh no, this is not going to be ran right.
Exactly.
Yeah. Again, it's one of the conditions that the underwriter is going to ask for, to mitigate risk on behalf of the bank.
100%.
Yeah. Oh, that's awesome, man. So what are some other things that you would say that stick out to you on things that you've seen in the past? Because you've underwritten, how many do you do it by a deal count, or do you do it by a number of, real estate purchase price on the underwriting? Like, do you say like
I lost count?
Oh, you've lost count. Okay.
Yes,
Okay.
but
I don't know. The reason why I say that is because I'm thinking from like a marketing standpoint. What would sound better? Like, I've underwrote 30,000 units versus I've underwrote, $5 billion in real estate.
It sounds better. The
dollar amount, right?
Yes.
That's what I'm saying. You don't keep track of that?
I don't. I stopped a while ago. But in amounts of deals, I don't know, at least 1,500 deals.
1,500. Wow. And what would you guess that pencils out to dollar amount, dollar value?
You can times that, what, $5 million?
Yeah. Okay.
Just do the math.
Yeah. Wow, that's a lot of underwriting.
Mm-hmm.
And RV parks are the favorite asset class, huh?
I like it.
Yeah.
I like it. It's creative.
Mm-hmm.
The other assets are more stable in that matter, but RV parks are creative. They're nice.
Yeah,
and it's good to operate. It's nice,
fun to operate.
Mm-hmm.
Love it, man. I love it. Are there any takeaway that somebody can have? Some of our listeners, what's a takeaway they can have from today about underwriting? What are like some good takeaways you can give them right now? Something that's simple, concise, that's a punchline that they're going to like, wow, they're listening to this. They're like, wow, that really hit home for me. Next time I'm looking at a deal, I'm going to look at this, like we spoke about what type of documentation to get from sellers. Right?
Yes. I think from my point of view, you have to educate a little bit yourself in the, understanding the numbers. You don't have to do it. You don't have to educate like in many ways to do it by yourself. You just have to understand it. And then pick a team.
Mm-hmm.
Get someone to do it for you.
But how does somebody get educated? Do they go to school for this?
No.
Well, how do they get educated?
I don't know. There are books. There are podcasts.
Mm-hmm.
There are YouTube channels.
Grant Cardone?
Or Grant.
Okay.
Yeah, there's a lot of information, free information out there. Yeah. That you can learn the ins and outs. I learned a lot from podcasts because when you are interviewing someone.
So you're telling me right now you're giving value to our listeners right now that potentially might get value off of what we're talking about?
Of course. Yeah,
wow.
of course.
I love it. Okay.
Because when you interview someone, you get the ins and outs of little details, and you can put that in action in your life.
Right.
That's important. Because when you read a book, it's just a book.
Right, correct.
Or when you have an interview of someone like really big, you say, okay, yeah, this guy worth billions, right? But when there's an interviews of people like they're not that big, then you get the insight.
I always say it like this, right? It's like kind of like when you go through like medical school or like you're an attorney. You do all this book stuff, right? And none of it like is or applicable to like your real life in the field work. Like when you actually work in the hospital, the skill set that you learn from working in the hospital and doing the thing is a lot different than actually the books, right? And so that's the same thing when I tell people. But the thing about this is like you say, hey, I learned from podcasts. I learned from Grant. I learned from this and that. What really gave you the confidence? Because I know there's going to be listeners right now that are listening, that are tuning into this, saying that, you know what? I am a Miguel. I am someone who likes spreadsheets. I am someone who likes numbers. I'm someone who now I can see myself inserting myself into deals. We're inspirational here, brother. Like, this is awesome. Like, people now are going to say, hey, you know what? I didn't realize that I can get into real estate deals without having to have the capital or find the deal or learn how to negotiate. What took you to having confidence from podcasting, listening, to watching Grant Cardone videos, to reading books or whatever it was? What took you from there to like, oh, I have the confidence now. I can do this. Like, I can underwrite. I'm going to start a consulting business for this.
There's a funny story that.
Don't lie to me.
At all.
All right.
I learned from all of that, right? But then there was a point that I was sitting with an investor, and then we were debating about a deal, and I had little confidence because I knew like all the terminology, but I didn't know that much. But everything that I said at that point was from the theory, like from all those podcasts. Hey, you can do this or you can do that. And then there was a couple of things that, oh, you're right. I was like, oh, I'm right. So it turned out that everything that I've learned in all those books and podcasts were true and practical in real life. I say, so it's the same thing. So then I figured out that everything that I've learned, I can apply it into real life.
Right. So doing the thing, which was underwriting, and presenting your knowledge of what you knew to an investor, a real life investor, and him validating what you said to being true.
Correct.
That was your first like, oh, wow, this is okay.
Exactly. That was the first conversation. And then I started working in a firm and talking directly with the CEO of the firm. I was analyzing. I got that job because of my knowledge, my previous knowledge.
Wow.
So when I got there and I saw everything that he has done, I said like, oh my God, this is exactly the same thing as the books.
Yeah.
As the podcast. It's the same thing. It's exactly the same thing. So I said, okay, yeah, I feel comfortable with this.
Wow. Mm-hmm. That's funny because I'll share it with you. You want something funny? When I got my first real estate deal, I was guinea pigging off of somebody else and what they were doing. They were doing buy and hold, and everything they were doing, I was doing. I was replicating it, right? Or excuse me, yeah, he was the guinea pig and I was just the follower, right? And I was replicating everything he was doing. But the way we work and our minds work is if you don't do the thing, whatever the thing is, whether I want to be an underwriter and never done it before, a real estate investor, a pilot, a doctor, a lawyer, until you actually do the thing, you'll never get confidence in knowing it works. So many people get caught up in the analysis paralysis and watching and listening to podcasts for years and years and years, and they sit on the sideline not doing the thing.
But you know what? Most of the time that what happened is because they have nobody surrounded him to take that action.
Right.
You know, if you start creating value to people, then you learn from those people.
Yeah.
The thing about that analysis paralysis is just them, and they think that they are just the one who has to do anything.
Right.
Everything.
Yep.
Oh, I'm not going to do this by myself. And it's fear.
Right. It's fearful, right?
Yes, 100%.
Right.
But it's not just you. You have to do it with people.
Yep.
That's why you have mentors or friends, but you have to start building relationship with people within that specific niche.
Yeah.
And that's something when you start to do something different than you were doing, you need to totally change your environment.
Yep. And basically what Miguel's saying is proximity. Everything in life is about proximity. If you want to play basketball better, you get around better basketball players.
Correct.
And you play with them every day. You want to become a better real estate investor, you get around better real estate investors and you hang out with them every day. You want to do anything better. You want to speak Chinese? Like, we don't know how to speak Chinese right now, but I bet you if we flew to China and we lived in China for 2-3 years, we'd get it, right? Because why? We're in proximity to individuals who are speaking Mandarin.
Exactly.
And if you think about that, if you want to make any type of, wealth, rich, whatever your success looks like, because that's different from anybody, you need to hang around those type of people. And one of the biggest downfalls most people make is they don't want to leave the old friends behind that are dragging them behind, who don't speak the underwriting language. So why are you hanging out with them? Who don't have the vision you have. And so until you can really grasp those things and say, you know what, these are my old friends, but these are my new friends.
Exactly.
And these are the guys I'm going to be around.
Correct. And the new friends, once you share that vision, they're going to say, of course, go for it.
Yeah. Absolutely.
Your old friends say, are you crazy? No, you cannot do that. That's too risky.
Too risky. Your old friends, you listeners, I want you guys to think about something like your old friends, your family members, everybody's going to downplay you. But at the end of the day, it's for you to show up. It's you that you battle with, your own mind, your own mentality, the way you speak, the way you act, the way you carry yourself, how you do anything is how you do everything. And one of the biggest things I see is the most successful people are very quick to make decisions. They don't sleep on things. And by the time they made that decision, they've already failed 15 times, right? And you might not make that same decision that they made. It might take you 2-3 years to make that decision. They've already made it. Money likes speed, guys. And you got to get in the game, and whatever game that is, by the way. I'm not talking about just like underwriting. If you're going to get in the real estate game, you got to get in it. And you got to surround yourself with people who are doing the thing. And the reason I like to call it the thing is because that thing could be different things. It could be acquisitions, underwriting, raising capital. It could be a lot of different things.
Correct.
So how do people find you, Miguel? If people say, hey, you know what, man, I want to get you to underwrite my commercial deal that's 200-300 units, or hey, I want you to underwrite my deal that's 6 units or 7 units. Do you have a specific, and I know I asked you earlier, you don't know you don't have a customer avatar, right? So are you working with anybody who's doing 5 units to 100 units? How does that person get in contact with you?
Anyone, yes, from 5 to 100 units, creative or not creative, any type of assets, as I told you. As you mentioned earlier about the mentorship program, I educate people as well. So you can course. Instagram,
Okay.
something at Facebook.
Okay? Tell the viewers, what's your Instagram handle?
It's MDSREI.
Okay.
That's the best way.
Okay.
Or email Miguel@bestequitycapital.com. Each one works.
These are the best ways to get a hold of Miguel if you guys want to work with Miguel directly to do consulting on your deals. Guys, I tell you, and I tell you over and over again, it's all about the buy. You have to buy right. If you do not buy right, your asset is not going to perform and you are not going to be in a good position. So make sure you guys collaborate with Miguel if you have anything that you want to partner on. Guys, you guys always know we love to bring value to you guys on Close to Capital with Javier Paredes. Make sure you guys like and subscribe to my YouTube channel at The Real Javier Paredes. And go to my Instagram. Give me a follow. Give me a like. Give me a shout out. I want to continue to bring value to you guys. And do me a favor. Go into my Instagram or my YouTube channel and drop a comment on my first video on my 3-day challenge that I have for you guys. 100% value to you guys who are in the co-living space. I hope to see you guys on the other side.